Most people ask the wrong question when they think about a major market breakdown. They ask, could I lose everything? The better question is, what are the chances I collect what I expected when I need it? Here's the honest answer. In a major market breakdown, most individual investors will probably collect something, but there is a real risk they collect less than expected, later than expected, and at precisely the worst time for retirement. Let me explain why. Point 1. Investors usually do collect something. First, let's be clear. Most market crises are price events, not system failures. We've lived through the dot-com crash, the 2008 financial crisis, the COVID market shock. In each case, markets fell hard, portfolios lost value, but investors still owned claims. Markets reopened, assets repriced, accounts remained. So this is not about people losing everything overnight. Point 2. The real risk is how and when investors collect. The danger shows up when a market decline becomes a systemic stress event. That's when leverage unwinds, margin calls cascade, and clearinghouses act to protect themselves. At that point, outcomes are governed not by fairness, but by legal priority. And that's where individual investors sit at a disadvantage. Point 3. The priority waterfall decides outcomes. In a systemic breakdown, losses are absorbed in a specific order. At the top of the waterfall, clearinghouses, derivatives, counterparties, repo lenders. They are protected by law. They must survive. Further down, broker-dealers, funds, retirement plans. And at the bottom, individual investors, 401k participants, IRA holders. That doesn't mean assets are taken, it means investors are residual claimants. They receive what remains after the system stabilizes itself. So what does collecting something actually mean? It often means forced liquidation at depressed prices, delays in access, recovery after senior claims are settled. Historically, that can mean 60 to 80 cents on the dollar, long recovery timelines, and permanent damage to retirement income plans. The retirement-specific problem. A 30-year-old investor can wait. A retiree cannot. Retirement fails not because assets go to zero, but because income disappears at the wrong moment. Account balances are claims. Retirement requires cash flow, and claims sit at the bottom of the priority stack. So the real lesson isn't fear, it's understanding structure. In a major market breakdown, investors usually collect something, but timing, priority, and leverage determine how much and when. That's why retirement security was never supposed to rely solely on market balances, and why restoring predictable income matters more than ever.